There is a house on a street near you that has been sitting vacant for over a year. The owner isn't selling it, isn't renting it, isn't doing anything with it, just holding it, watching it appreciate, collecting the unrealized gain like a coupon from a machine that never runs out of paper. And 2 miles away, there's a 23-year-old working a full-time job, with decent credit, no debt, and some savings, who cannot afford to rent a one-bedroom apartment in the city where they grew up. Not buy, rent. These two things are happening at the same time, in the same economy, under the same government, and neither of them is an accident. Because the American housing market isn't broken. That's the wrong framing entirely. Broken implies something went wrong. Broken implies nobody meant for this to happen. But what's actually going on is far more deliberate, far more profitable for the right people, and far more difficult to fix than anyone in a position to fix it is willing to admit. So let's talk about what's actually happening. Because the housing crisis isn't a story about interest rates. It isn't a story about greedy landlords or remote workers fleeing cities or millennials spending too much on avocado toast. It's a story about supply. Specifically, the deliberate, sustained, politically protected destruction of housing supply across every major city in the United States. And the people who killed it know exactly what they did. Let's start with a number. The United States is currently short approximately 4 million homes. 4 million. That's not a rounding error. That's not a footnote in a policy paper. That's the gap between the number of homes that exist and the number that would need to exist for the housing market to function like a normal market. And that gap has been building for decades. Because from 2008 to roughly 2020, home builders essentially stopped building. The financial crisis wiped out a generation of smaller developers. Lending dried up, labor costs rose, and the political will to zone new housing into existence evaporated. But the supply problem didn't start in 2008. It started in the 1950s, with a policy so boring sounding that most people's eyes glaze over the second they hear it. It started with zoning, single-family zoning. The rule that says this land, this specific piece of land, can only ever have one house on it. One family, one structure, no apartments, no townhouses, no duplexes. Just one house, one lawn, one driveway forever. In most major American cities, somewhere between 60 and 75% of all residential land is zoned exclusively for single-family homes. In cities like San Jose, that number is closer to 94%. Think about what that actually means. In one of the most expensive housing markets on the planet, 94% of the land designated for people to live on is legally forbidden from having more than one home on it. You could own a plot of land in the middle of a city where apartments rent for $4,000 a month, and you would be legally prohibited from building anything on it that might house more than one family. Because someone decided in 1962 that this was a good idea and nobody with enough political power has disagreed loudly enough since. Now, why does this persist? Because here's where it gets uncomfortable. The people who have the most power to change zoning laws are homeowners, and homeowners, as a group, have a direct financial incentive for housing supply to stay constrained. Because when supply is constrained and demand keeps rising, prices go up. And when prices go up, their net worth goes up. Their single largest asset appreciates. Their retirement plan works. Their neighborhood stays exactly the way it was when they moved in. So when a city council meeting happens and someone proposes rezoning a neighborhood to allow duplexes or small apartment buildings, guess who shows up? Not the 23-year-old who can't afford rent. They're working. They're exhausted. They don't have time for a 3-hour city council meeting on a Tuesday night. The people who show up are the homeowners. The ones who bought in 30 years ago. The ones whose homes are worth 4 times what they paid. The ones who have every incentive in the world to vote no, dress it up as concerns about neighborhood character or parking or traffic, and go home feeling like they did something civic. This is called the NIMBY problem. Not in my backyard. And it is one of the most effective, most durable, most quietly destructive political forces in modern American life. It's not ideological. It's not partisan. It cuts straight across party lines because a Democrat homeowner in San Francisco and a Republican homeowner in Phoenix have exactly the same financial interest in keeping new housing out of their neighborhood. And the result, after decades of this, is a country where the places people most want to live have made it structurally illegal to build enough homes for the people who want to live there. But wait, it gets worse. Because into this supply-starved market, starting around 2012, walked a new kind of buyer that the housing market had never really dealt with before at scale. Meet the institutional investor. After the 2008 crash, private equity firms started buying distressed single-family homes in bulk, tens of thousands of them. At first, it looked like a niche play, some vulture capital cleaning up after the crisis. Fine. But then something happened. The returns were extraordinary. Single-family homes, especially in Sunbelt cities, were generating rental yields that made commercial real estate look boring. So the playbook expanded, and by 2021, institutional investors were purchasing roughly 1 in every 7 homes sold in some of the hottest markets in the country. 1 in 7. In Atlanta, in Phoenix, in Charlotte, in Tampa. Not apartments, single-family homes. The exact homes that first-time buyers, young families, and working people are competing for. And the institutional buyer doesn't need a mortgage, doesn't need an inspection contingency, doesn't need 30 days to close. They show up with cash, offer above asking, and close in 2 weeks. And the family that saved for 3 years and got pre-approved by their credit union loses. Again. Every time. Now, to be fair, the math on how much institutional ownership actually drives prices is genuinely debated. Some economists say the volumes aren't large enough to be the primary driver. And they're probably right that institutions alone didn't cause the crisis. But they didn't have to cause it to make it worse. Because in a market that's already running a 4 million unit deficit, every additional source of demand that can outcompete regular buyers matters. You don't need to be the cause of a fire to make it harder to put out. And here's the mechanism that really doesn't get discussed. When an institutional investor buys a home and converts it to a rental, that home is now permanently off the for-sale market. It doesn't come back. The owner occupancy rate in that neighborhood drops, which makes it harder for other homes nearby to appraise at values that support purchase financing, which suppresses mobility, which locks existing renters in place, which reduces the supply of homes available at any given moment. One purchase creates a chain of downstream effects that compounds the shortage. And the people running these funds are not stupid. They know exactly what they're doing. They're not malicious. They're just rational. They found an asset class with artificially constrained supply, consistent demand growth, and a political system that was practically designed to protect their investment. Of course they piled in. So where does that leave the person actually trying to buy a home right now? Staring at a market where the median home price in the United States crossed $400,000, where mortgage rates, even after coming down from their peak, are still making monthly payments on an average home consume 40% or more of median household income, which is roughly double the historical norm, where the down payment required to buy a median home now takes the average first-time buyer over 12 years to save. 12 years of saving to get to the starting line, and the advice they get is staggering. Lock in now before prices go higher. Move somewhere cheaper. Stop renting and throwing money away, which is remarkable advice to give someone who cannot afford the alternative you're describing and would prefer to live within a reasonable distance of their job, their family, and their life. Here's the gut punch. The most reliable path to building wealth in America has historically been homeownership. The appreciation, the forced savings, the leverage, the tax treatment. All of it compounds over time in a way that renting simply does not replicate at the same scale. So when an entire generation gets priced out of that vehicle, it's not just a housing problem. It's a wealth-building problem. It's a retirement problem. It's a class mobility problem that shows up 30 years from now when the same people who couldn't afford to buy in their 30s are also the ones with the thinnest financial cushions in their 60s. And none of this is changing fast, because the homeowners who benefit from high prices vote in every election. The developers who want to build are tied up in years of permitting, environmental review, and community opposition. The institutional investors have lobbyists, and the 23-year-old renting a studio apartment with 2 roommates is not a powerful political constituency. So what can you actually do with any of this? A few things worth knowing. First, local elections matter more than federal ones on this issue. Zoning is decided at the city and county level. The school board member, the city council person, the county supervisor, those are the people who control what gets built and where. If this bothers you, that's where the leverage is. Second, the Sunbelt still has more supply flexibility than coastal markets. Cities like Austin, Raleigh, and Columbus have permitted significantly more housing relative to demand than cities like Los Angeles or Boston. The price gap reflects this. It isn't destiny. Third, the build-to-rent trend is worth watching. A growing number of developers are building single-family homes specifically intended as rentals from day one. This adds supply even if it doesn't add owner-occupied units. It won't solve the problem, but it blunts these edge. Fourth, understand the political economy before you move. A city that has consistently rejected new housing for 30 years is not likely to suddenly reverse course. That trajectory has a long tail. Price it accordingly. Fifth, the assumption that home prices always go up is a local phenomenon, not a law of nature. Japan's housing prices are roughly the same today as they were in the early 90s. Supply matters, demographics matter, policy matters. Markets don't stay this distorted forever. Eventually, something adjusts. It just usually isn't pretty, and it almost never benefits the people it should. So here's where I want to hear from you. Do you think the housing crisis gets resolved by A, supply-side reform that finally forces cities to allow more building, B, a demand shock like a recession or demographic slowdown that brings prices back to earth on their own, or C, nothing changes and we just quietly accept a country divided between people who bought before 2015 and everyone else? Drop your take in the comments, because this one hits differently depending on which side of that line you're sitting on.